Welcome to our comprehensive overview of the central bank, the financial market, and the stock exchange. These three entities have a significant and interconnected impact on the global economy, shaping the trajectory of nations and the lives of individuals. A central bank is a financial institution that conducts monetary policy and regulates the supply within a country. Central banks periodically employ various tools, such as interest rates and open market operations, to manage inflation, ensure economic stability, and foster sustainable economic growth. Additionally, central banks are responsible for overseeing commercial banks in their country, as well as maintaining and managing the country's foreign exchange reserves. Moving on to the financial market, it comprises various instruments and participants facilitating the exchange of financial assets such as stocks, bonds, currencies, and commodities. These markets also serve as crucial sources of capital for corporations and governments. They issue securities to raise funds from investors, which are then used for business expansion, infrastructure projects, and other development initiatives. Lastly, we have the stock exchange, a type of financial market specifically dedicated to trading company stocks and other equity-based securities. Stock exchanges provide a regulated platform for the buying and selling of stocks. This regulation ensures transparency, reduces transaction risk, and provides a fair market for all participants. Public perception of the stock market often revolves around the concepts of bull and bear markets. A bull market signifies rising asset prices and investor optimism, while a bear market denotes falling prices and investor pessimism. These terms represent dynamic market fluctuations linked to various factors, including interest rates, corporate earnings, geopolitical events, and even public sentiment. Gains and losses experienced during bull and bear markets can significantly impact individual and institutional investors. The interaction between the central bank, financial markets, and stock exchanges is fascinating and multifaceted. It's a crucial ingredient of modern economic systems, influencing the flow of money and shaping not only the current economy but also its future prospects. To delve deeper, we can consider a key component of this relationship: monetary policy. When the central bank creates or alters its monetary policy, it has a direct and immediate effect on financial markets and, consequently, on stock exchanges. For instance, if the central bank decides to lower interest rates, it reduces borrowing costs and diminishes the attractiveness of savings. Consequently, this policy may stimulate economic activities, encourage consumption and investment, and potentially lead to a bull market. Conversely, higher interest rates may temper an overheated economy to prevent inflation. In the short term, raising interest rates can trigger a bear market as it makes borrowing more expensive and incentivizes investors to save rather than invest. The relationship here is neither linear nor are the effects immediate. Market participants, composed of consumers, producers, investors, and financial institutions, interpret and react to policy changes differently, adding further dimensions and uncertainties to the equation. Stock exchanges continuously adapt to these shifting dynamics. They serve as barometers of market sentiment and economic health, pulse points informing us about the state of the economy. Traders, brokers, and analysts on a stock exchange diligently work to leverage their insights and predict market directions. Their analyses, strategies, and transactions, in turn, shape financial markets and influence the central bank's policy assessments. Conversely, stock exchanges avidly consume market information to gauge investor expectations and risk appetite. This information typically permeates financial markets, influencing everything from bond yields to venture capital investments. Of course, market performance isn't dictated by one or two events or indicators. It's a vast puzzle of many pieces, continuously molded by news events, earnings reports, economic data releases, and investor behaviors. When analyzed comprehensively, the interaction between the central bank, financial markets, and stock exchanges is a symphony of economic activity. It ebbs and flows, creating currents of bullish and bearish sentiment that propel the modern global economy. In summary, these three entities are inextricably linked. The central bank influences the financial market by setting monetary policy. Conversely, the financial market influences monetary policy by providing the data used to monitor the economy. Stock exchanges, therefore, provide the signal of the success of these policies. This forms a cycle. The central bank formulates economic policies, financial markets react to and influence them, while stock exchanges demonstrate their success. As this cycle continues, central banks will continue to closely monitor market activity, financial markets will keep a pulse on economic data, and stock exchanges will remain bastions of investment opportunities. Whether as an occasional investor or simply interested in better understanding the economy, staying attuned to these key areas can provide valuable insights. Lastly, remember that all dynamics are part of the natural cycle of economic ebb and flow. They're not something to be feared or viewed pessimistically, but rather empowering tools allowing you to take control and be a savvy participant in the world of finance. Don't hesitate to be an active participant. Subscribe to our YouTube channel's Financial Current and let's continue shaping our financial destiny.